Hello students, how are you? I hope you're all fine and making all efforts to pass the exams with good marks. So students, let's start in a couple of minutes. So we were doing IFRS 15 in the last class, and the two important points that we noted were that the revenue that will be recognized in the financial statements in case of a long-term contract depends on how much obligations have been satisfied. What is the progress of the work? The more is the progress of work, the more revenues and more profits we recognize, right? So it depends on the progress of the work. But when profits are expected, if losses are expected, in that case, you won't be using the progress method, right? In case of losses, all losses are recognized immediately in the profit and loss account when they are incurred. On the basis of expectation, we recognize the losses fully, right, when they are expected. So this was what discussed in the last class. Now let's move ahead and do further questions and practice work so that we can learn more concepts on this IFRS 15. Today's topics on priority, which I have kept so that we can cover the more important, the difficult ones and the newer ones. So today we'll be doing IFRS 15 first, then we'll be doing the tax expense questions, IS 12, deferred tax and current tax and all. And then we'll be doing IS 23, borrowing cost, and then we'll be doing impairment of assets, IS 36. So these are on priority, and then other standards which will remain will be done after this work has been completed. So let's start, students, with IFRS 15. Remaining questions. Question number 12. So in question number 12, what they are asking is, they are asking about what amount would be reported as a contract asset in Y-Link's statement of financial position as at 30th September 24. So by the contract asset, they mean that what receivable amount against the contract will be reported in the financial statements. So obviously in the profit and loss account, we'll be reporting the revenues, expenses, and profit connected to the contract. But the balance sheet, you should be reporting some receivables or payables from the customer or payable to the customer. So the amount of receivable is required. Now, what's the formula according to IFRS 15 for calculating the contract asset is as follows. So it is like this: cost to date cost which has been incurred till the reporting date, we'll take it and we will add the profit recognized. Okay, to date. So until the current date, what the profits which has been recognized will be added to it, right? And if losses has been incurred, so you will be deducting the loss incurred. means if losses have been incurred, we'll be asking for less amount. So we will deduct it from there, right? So in the cost incurred, we'll add the profit, right, to calculate the receivable. And if losses have been incurred, we'll deduct it. And from that amount, obviously, if already some amount have been billed, then we will deduct from there. To deduct the billed amount. So if you deduct the billed amount and still some balance remains, this means that this amount is still collectible. So this will give you the contract asset if it is positive. But if it is a negative amount, then it will be contract liability. So this is standard working of the contract asset or contract liability. Okay, let's put figures into it in order to arrive at the contract asset. So first we need to know the cost incurred to date. So according to the question, you can see the cost incurred to date, which is 1.6 million. The cost incurred on the contract was 1.6 million. Now, after putting in 1.6 million, we've been requiring the profit that has been recognized. So we have to know the profit. We need to know the profit, that what profit will be recognized. So what we will do, first calculate the total profit, and then the profit recognized will be equal to the progress that have taken place. So first, let's calculate the total profits. So for total profits, take the contract price. The contract price over here is 5 million, and then deduct the total cost that is expected. So the total cost includes cost to date and estimated cost to complete. Okay, so the cost to date is cost incurred to date is 1.6 million, and the estimated future cost is 2.4 million. So if we deduct both of these from the revenues, we arrive at the profits, which is 1 million. So the profit expected over the 2 years contract time is 1 million. And now out of 1 million, how much of the revenue shall be recognized? So the revenue recognition depends on the progress. Okay, how much progress has taken place. So for the progress of the work, we need to use the formula. So they have told you the formula that how the progress is measured. So the formula for measuring the progress is Yiling calculates contract progress using output method. Output method means using the revenues or the contract price, and input method means the using the expenditure incurred method. So over here, on the basis of the amount billed compared to the contract price. So amount billed divided by the contract price. This is the output method in this case. So what we will do that we will take the amount billed. The formula will be given in the question, like over here, what they say, the amount billed compared to the contract price. So amount billed in numerator and contract price in denominator. So The amount billed till now is 1.8 million has been billed, means the amount invoiced, and the contract price is 5 million. So if you divide it, you will get 36%. So this makes 0.36, 36%. Now, so putting figures in this format, the cost incurred to date is 1.6 million, and then the profit that will be recognized till now is 1 million into 36%, which makes 0.36. Then obviously profit and loss both cannot incur together, and the billed amount is 1.8 million, which shall be deducted from this. This leaves back the contract asset. The contract assets amounts to 0.16. So the correct answer is $0.16 million. So that's the answer. So let's move on to the next question now. That's the work that was working for the contract asset. Next is question number 13. Okay, students, one more thing I want to tell you, that if you note here today, you will be seeing an Excel sheet, practice to pass presentation for the participants, right? So this is the previous class workings and some diagrams and concepts which are being made available to you today. So this do not include IFRS 15 till now, right? So because IFRS 15 was not complete, and other topics are present there. So I in the last class I gave you some questions to attempt from IFRS 16 from leases, yeah, right? Do you remember those 5 questions given by me? So what I've done, I have included the workings of those questions as well in this sheet. So if anyone wants to know how I have arrived at those answers which were given to you yesterday, so you can go through that IFRS 16 sheets, right? So when you go to the Excel sheet, Excel workbook, you will be having a lot of sheets down, right? Which like you can see over here as well. IFRS 9, then IS 38, then IS 33, IS 21, IS 8, IFRS 5, IFRS 16. So till here you have got in here, right? So you can use now, and if you have any questions from me, you can ask on the WhatsApp group as well, right? So let's continue with IFRS 15, students. Question number 13. Okay, so in question number 13, they are asking about the revenues and cost of sales. The correct revenue and the cost of sales on 31st of March 2005. Now, just note that what's expected over here, profit or loss. So what they say that CN incurred cost to 31st March 2005 of 77 million. 77 million has already been incurred, and it estimates that a further cost of 33 million will be incurred. So if they incur a further cost of 33 million in future, the total cost is going to be 110 10 million, right? And the contract price is just 90 million. So this means that they are going to incur a loss. Loss is expected from this contract. So what's happening that the contract price is 90 million and the cost of the full contract is expected to be 110 million. So this results in an expected loss, and the loss amounts to 20 million. So if loss is expected, you have to recognize all of the loss immediately, right? Now, the next point, that revenue will be recognized on the basis of progress only. Revenue will be recognized on the basis of progress. So what progress has occurred till now, that needs to be calculated, and they have given the formula. So what they say, that the progress of the contract using completed work completed to the contract price. This is the formula given by them. So work completed is of 63 million as per the surveyor. So they have hired a third party to value the work that has been completed. So work has been completed up to 63 million out of the contract price, which is 90 million. So this is how we can calculate the progress over here. Okay. In this way, we get the formula for calculating the progress. So let's calculate the progress first. So the progress has been 63 million divided by 90 multiplied by 100. So this has been 70%. So the revenue will be recognized %70 of the total price. Revenue cannot be recognized more than the progress of the work. So that's the revenue, 90 into 70%. Now what about the cost of sales? So as I said earlier in the last class, the cost of sales will be the balancing figure in case of the company incurs a loss. So as a loss has been incurred, so expected losses shall be recognized immediately. So you have to recognize the loss equal to 20 million in the current year only. Full loss will be recognized immediately. So if now you want to have a 20 million loss, what shall be the cost? Obviously, cost should be more than the revenues. So 63 plus 20 will be the cost. 63 is the revenue and the cost should be more by 20. So you will arrive at the 20 million loss. So 83 is the balancing figure over here. In case of, but in case of profits, you will be taking total cost multiplied by progress as we used in the last class. So now your answer is cost 83 and revenue 63. So that's your correct answer. Okay. So students, let's move to the next question, which is question number 14. Now, this is a bit different from, this is not on long-term contracts or construction contracts. This is a bit different. This is related to discount. Usually when you go to various shops or restaurants or to purchase some garments type of thing or furniture, usually you get packages from the suppliers of these items or the sellers of these items. So what they do in the package, they are charging less price compared to if you are purchasing individual products. If you are buying individual products separately, you would have been paying a very high amount. But if you take collectively those products, you buy at a very lower price. So how will you recognize the revenue in that case if you purchase collectively? So what they say, that if you are buying collectively, the total discount means that the packaged price and the separate prices of all the products, the difference between them will be allocated over all the products. This cannot happen that you allocate discount on one product only. You have to allocate the discount on all products. So let's see question 14, how it happens. How will you allocate over all the products? See, in this question, you are having 3 products and their individual prices are as follows. You can see the red line and the block made by me. So selling price of goods is 75, installation is 30, and 45 is the 1 year service price, right? So the sum of all this is 150. If you buy individually, you'll have to pay 150, but the package price is 100. So first, what needs to be done over here, you have to allocate the discount to all products. All products will be sold, including services, goods, services, everything will be reduced by the discount. So how will you allocate the discount? Let's check. So goods, installation, and 1 year service. The individual prices are 75, 30, and 45. Now, how you allocate the discounts? What you do, that if you buy the package, how much will you be paying? 100 out of 150. The same ratio will be taken to calculate individual prices. You have to just check that what amount is to be paid in a package. So in a package, you will be paying 100 out of what? 150. So all products will be multiplied with the package price divided by the individual total of the individual prices. So in this way, you arrive at the discounted prices, and discount will be allocated to all products in the same way. So in this way, the total of all gets 100, and earlier without the package, the total of all the products was 150. So discount is allocated to all products in the same way. Now, this was the price, normal price, individual, standalone prices, and now we arrive at the discounted. Now remember, when recognizing revenue, you have to see that what obligations have been satisfied, what level of services has been delivered. So revenue to be recognized depends on the obligations which has been settled. So let's find out that what obligations have been settled. They have delivered the goods on 1st May 2001, and they have installed the goods as well. So the revenue in respect of the goods and the installation has already been earned. They have satisfied the obligation. But what about the services? The year end is 31st December. since May till 31st December, the services have only been rendered for 8 months. You cannot recognize the whole 12-month services. The 30 million is meant for 12 months time, and you have just rendered services for 8 months till now. So revenue will be recognized till 8 months. For 8 months, revenue will be 20. So this is what the revenue that can appear in the profit and loss account for the year ended 31st December 20x1. So it is 90. So 90 is the correct answer to this blank. Right? So step 1, we allocated the discount to all products on the basis of the prices charged together divided by the individual total of the individual prices, right? And then after getting the discounted prices, we determine that what obligations have been fully satisfied. What obligations have been fully satisfied takes you to the total full recognition of revenue, and one of the item 1 year service was just delivered for 8 months, so we cannot recognize full revenue. So over there we are recognizing revenue to the extent of the obligation that has been satisfied for 8 months, right? So that's the answer to this question. Okay, let's move on to the next one. Okay, you need to give the order. So in IFRS 15, they have given an order, the approach to recognizing the revenue. So what's the order of the revenue recognition process? So the first in the order comes, identify the contract. First, you need to see whether the contract is for goods and services or not. Otherwise, in case of a contract for a loan, you cannot recognize revenue in that case, right? So over here, you should first check that contract is with a customer who wants to buy goods and services only. Then you will be moving further. So first step is identify the contract. Then once the contract has been identified, you will check that what are the performance obligations. Like in the previous question, the question number 15, there were 3 performance obligations. They had to deliver goods, they had to give the installation service, and they had to give a 1 year service. So 3 performance obligation the contract was including. And next, once you know that how many there are obligations, suppose 3 obligations were there in question number 14, then you will see what price is being charged. So contract price being charged, this was the third in the order. Then once you know the price, you allocate the price. The price was 100, so we allocated the price amongst the products. So the next step was allocating the price. So in the fourth step, we allocated the price, and then finally we checked that what level of obligation was met. Like in the 1 year contract, only 8/12 was the level of obligation which was met. So recognize revenue when a performance obligation is satisfied. And like how much is the progress of the work? If the progress is 100%, recognize the revenue full, and if the progress is less, recognize less level of revenue up to the obligation that is satisfied. So these are the 5 steps. Let me do it in one more way. This is the first one, identify the contract. Second in the order will be identify separate obligations. Third one is in the order is determine the transaction price. Fourth one was allocate the transaction price to the separate performance obligation. And the fifth step is record revenue on the basis of the progress of the work. So these were the steps. Okay, so students, let's move on to the next question, 16. We have already done 16 in the last class. This was a simple question with which we started in the last class. Okay, let's do question number 17. So in question number 17, they are asking about the net liability. They are asking about the net liability that should be recorded in Sugar's statement of financial position, the liability they want. So liability, by liability means the contract liability that needs to be recognized. So for the contract liability, I gave you a small pattern of working in the earlier question. Let's move on to that working. Let's use the same working to calculate this one as well. So I am going to copy that working. Okay, this was our working. Okay, so let's put in the amounts. In this case, they say that there's a contract liability. Okay, okay, let's put in figures. So what they say that let's figure out the main things, that Sugar has spent 4.5 million to date. Till now 4.5 million has been incurred, but the estimated cost mean the remaining cost to complete 5.5 million. So the total cost become 10 million, but the contract price is not 10 million. The contract price is 8 million. Price of the contract is in purple, 8 million. So they are expecting a loss of 2 million, right? So now what they are going to do in this case, and the buyer has already paid how much? 3 million has been paid by the buyer. So let's now do the working. Now this has got simple. We've got the figures. The contract price was 8 million. For the total cost, 4,500 already incurred, 5,500 yet to be incurred. This makes 10,000. And if we deduct 10,000 from 8,000, we arrive at a loss. So loss is expected over here. And in case of loss is incurred, you have to recognize all of the loss immediately. So in this case, all of the loss will have incurred immediately. So by loss, we mean that if you have spent 4,500 till now, you won't be able to charge 2,000 from the customer. So deduct it from there. The amount of loss you can't charge from the customer. So you have deducted from 4,500 cost to date. And then the billed amount is 3,000. So you already billed 3,000. So now what happens? You had to charge just 4,500 minus 2,000, which makes 2,500. But you charged 3,000, so you have overbilled it. So overbilling has taken place. You have received more than what you should have received. So you have some unearned amount from that customer. So your answer is minus 500. So there is a contract liability. Correct answer is it is $500,000 in fact, because it's in millions. So it is going to be $500,000. So that was the answer to this question number 70. Okay, so let's move further. Let's move on to the question number 18 now. Okay, now in the question 18, just note that they are talking about 2 years. They have given you the data 2005 and 2004, and what they are asking about is related to 2005. They are asking that what should be included in statement of profit and loss for the year ended 30th September 2005, and the contract has started in the previous year. So how will you account for over here? So the rule is, if you're working on progress basis and the contract commenced in the last year, in 2004 it commenced. So what you have to do, you have to calculate on cumulative basis. First, calculate the total cost of sales for both years, 2004 and 5. What should have been the cost of sales cumulative, right? And then deduct the cost of sales up to 2004. So already the middle figure, the figure in between the total of the 2 years, deducting the 2004 figure, will give you the 2005 amount to be recognized in the profit and loss account. So the difference will be recognized in 2005. So what we will do, we will first calculate the cumulative amount. We'll calculate cost of sales up to 2005. Likewise, if you are asked for the 2005's revenue, first you will calculate the cumulative and then deduct up to 2004. Okay, so how we will do it? So it's like this, and the remaining is cost of sales in the current year. This is the difference. Now let's work on individual figures. Now what happens? How do we calculate cost? Cost is calculated as follows. The total cost is equal to, according to the question, if you note, the total cost, total expected cost of the contract are $800,000, right? And the other way around to calculate the total cost is, as you know, cost to date plus estimated cost to complete. In this question, they have not given you that what is the estimated contract cost. Otherwise, if they have given you the estimated contract cost to complete, always calculate the total cost by adding cost to date with the estimated cost to complete in order to arrive at the total cost. Okay, so now this is the total contract cost, and the percentage of completion is going to be calculated using this method. Written recognizes progress on the basis of the work certified compared to the contract price. And you know that the contract will end in a profit, right? The contract is going to end in a profit, and last time what cost of sales did they recognize? 240. So if they are earning a profit or expecting a profit, they can use the progress method, and up till last year they have recognized 240. So what will be recognized for the current year? So what happens in the question? 800 is the contract cost, out of which you will be recognizing the percentage of work that has been completed till now. 240 has already been recognized in the prior years, right? So first you have to calculate the progress. So progress of the work is work certified divided by the contract price. So the work certified is 575. Oh, sorry, 1050 is the work certified. The work certified is it is 1050 in 2005, and the contract price is 1500. So divide this in order to arrive at the percentage. 1050 divided by 1500. This makes 70%. So let me show you that 1050 is the work certified amount till 2005, right? So it makes 70%. So out of 800, which is the total cost, 70% has been incurred. This makes 560. So the cumulative amount is 560, out of which 240 was recognized in the past year. So take the difference, 320. This is the amount which is to be recognized in the current year. So the correct answer is A. So if you are given to ask, so you are given to calculate the current year's figures, and the contract is being continued since past few years. So what you are going to do, you are going to calculate the cumulative amount till now, till the end of the current reporting period, and then deduct out of it the amount which has been recognized till the previous year. So the difference will be the amount that will be recognized in the current year. So that's how it will be done. Okay. So students, let's move on to the next question. Sawyer. So this question also requires you to calculate the contract asset. So let's calculate the contract asset. This is a simple one. So let's do it. Same pattern will follow. So as per the question, the cost incurred to date is 530,000. Now we need to know the profit that has been recognized. So the contract price is 1 million. Cost incurred to date is 530,000, and the estimated cost to complete is 170,000. So the total cost sums up to 700,000. So the profit expected to be earned is 300,000. Right? Now we need to know the progress. So the work certified is of 600,000 and billed amount is also 600,000. So the progress of the work is 600,000 divided by 1 million. This makes 60%. Now see, in this question, they have told you about the progress. So they do tell you about the progress. They are using the output method, work certified compared to the contract price. Okay, so the profit that will have been recognized will be 300,000 multiplied by 60%, the progress of the work, which makes 180,000. And the billed amount is 600,000. The work certified and invoiced is 6 lakhs. 6 lakh is already been invoiced. So we will read it like this: 530,000 was the cost which should ask the customer to pay, and we earned 180,000 profit, which should also be charged to the customer. So we have added it, and already we have billed 600,000. So what's the remaining amount to be billed? It's 110,000. So that's the correct answer, A. Okay. Next, question number 20. The students at 6:50 will be having a break for the prayers and a bit of refreshment as well if you want. So Hindberg is a car retailer. Now this is an important one. Look, there is an important concept. If a customer has entered into a contract with you and he will be paying a lot late, or he's paying a very much earlier than the normal credit terms. So if the customer is paying around 1 year or 6 months late after you have sold the product or given the service, then there is a financing arrangement between you and him. Means you have given him a loan. You have allowed him to pay after 1 year or 6 months time. So you are allowing him a finance. So there should be some interest that the seller is charging to the buyer. So all of the amount will not be taken as sale of goods. Out of the sale of goods, you have to deduct some amount of interest, which is a separate revenue, right? And it is dependent on the time, and the revenue of sale of goods will be recognized immediately because you would have delivered the 100% of the goods. If you wouldn't have delivered the full goods, the revenue will be recognized upon the basis of the progress. So in this case, what you see, just check the question. If you read the question, what they say, okay, Hindberg is a car retailer, and on 1 April 2004, it sold a car to Letterly on following terms. So it's sold on 1st April. Now, when is the party paying to pay? Selling price of the car was 25,300. Letterly paid half, 1260, on the same date. So this was paid in cash on the date of sale. But what about the remaining amount? This will be paid 31st March 2006. Remaining amount on 31st March 2006, which is 2 years afterwards, 2 years after the sale. So this means that the 12,650 amount is paid immediately. So that's cash payment. The remaining amount will be paid in 2 years time. So it means it includes interest for 2 years. So you have to take the present value of that amount, 12,650. So what's the interest rate, which is 10%? So the sale amount over here is, you have delivered the product. As you have delivered the product and full work has been done, so all sales will be recognized immediately. But what will be the sales amount? Cash paid and it's 12,650. It will take a minute at most, and then we'll have the break. And payable in 2 years time, we have to calculate the present value for it. Present value of amount payable in 2 years. So what happens, that take the present value of this amount. So 12,650 multiplied by 1.1 to the power minus 2. 1 plus r to the power minus 2, the present value fraction, right? So that's the sale amount. Now, as 1 year has elapsed, 1 year interest shall be recognized on 31st March 2005. So along with this amount, total of these two, 1 year's interest has also been accrued. So you will record 1 year's interest as well. So 1 year's interest income on this borrowed amount, which will be 23,030 multiplied by 10%. Sorry, 10,380 was the amount, which was the balance on which you will take 10%. So this makes 1038. So total income will be $23,030 plus 1038, the interest income, $24,068. So this is approximately D. The correct answer is D. Okay, let me correct. There's a clerical accuracy problem. 12,650. This makes 10455. So the amount will get. Let me make a correction. I took 12,560 instead of 12,650. So 10,455 into 10% will make 104.5. So total income will become 23,105 plus 1046. So this makes Please check on your calculator. Calculate the present values and check the answer. So the sum of these two values, 23,105 is the present value, and then 1 year interest 1046 on 10,455 gives you. Okay, so sorry students, we have got a bit late, 5 minutes late. So let's continue after the break. We continue after a 15-minute break. So let's continue after the prayers and the refreshment break in 15 minutes time. Okay, see you then. Welcome back, students. Let's move ahead. If you have any more questions, you can ask on the WhatsApp group as well. Some questions I keep on answering as I get questions on this chat. Some questions I'm not being able to read properly. That's why I'm not being able to answer. So you can ask one of the questions from Uruj. Not be able to properly read it, so I'm not able to answer. Well, so if you have a question, you can ask on the WhatsApp group. So I will answer you over there. Okay, so let's continue. Question number 21 to 25 were done in the previous class. So let's move ahead. Okay, 24 was left. Question number 24 was left. Let's do the question 24. Bailey's assistant accountant is unsure about how to deal with a brand new contract where the progress and overall profit cannot yet be ascertained. Which of the statements below are true? Statement 1, where the progress and overall profit are unknown, no contract asset or liability can be recognized. This is not correct. Even if you do not know that what will be the profit, but you are providing service, so you may ask for some money to them, or they would have given some advance to you. If they have given you an advance and you may have to return in the end to them, so there can arise an asset or a liability. So this is not correct, this is false. So even in a loss making contract, some amount will have to be paid and needs to be paid. Second statement, where the progress and overall profit are known, revenue should be recognized to the level of the recoverable cost. So what they say that when they know the progress also and the profit also, they do not know both. Neither they know the profit nor they know the progress. What is the progress? So in this case, you cannot record profit, right? You cannot record profit in this case. But what happens that in this case you say that the outcome of the contract is not certain. So in this case you cannot record any profits. So the maximum revenue that you can recognize is to the extent of the cost. You cannot record more than the cost. Suppose you incurred a cost of 500,000, right? And you expect that you will be able to receive only 400,000, right? So what amount is recoverable? Only 400,000. So you won't record more than 400,000 as revenue. Is it clear? And suppose if it is 550,000 recoverable, then you will record only 500,000 revenue, because only revenue shall be recorded up to the cost that is recoverable, which is 500,000. Cost is 500,000. And suppose you expect 550,000, you will record up to 500,000, because if you record more than 500,000, you will be getting a profit, and profit cannot be recognized when the progress or the overall profit are not known. So this statement is correct. Statement 2 is correct, that revenue should be recognized to the level of the recoverable cost. Okay. So question number 25. Bailey's assistant has also inquired about changing the way of measuring the progress of contracts. So they have changed the way of measuring the progress. So complete the following to show how the change should be applied. as a change in accounting dash. So is this a change in accounting policy or an estimate? This is a change in accounting estimate, because the progress rate, as I said, like the portion of consumption or the portion of revenue, if I'm calculating any portions, calculating portions is an accounting estimate. So the first blank will include estimate applied prospectively. Change in accounting estimate is applied prospective. So this is about portions. Calculating portions means estimation. That's the correct answer. Okay, now the next question is 26 to 30. Okay, question number 26. How much should be recorded in Craig's revenue in its statement of profit or loss for the year ended 31st December 2017 in relation to the large machinery? Now see, in this case, what happens that price is 800,000 in total, out of which 2 year servicing, out of which 2 year servicing amount is 240,000 and the installation fee is 50,000. So if we break it up into three portions, so there are three items. Out of this, 240,000 is installation, sorry, 50,000 is installation, and 240,000 is fee for 2 year service. And one more amount is in there, and that's for the machine. So machine is of 510,000, the price of machine. So now what has happened? They have delivered the machine, so full revenue should be recognized. They have installed it, full revenue should be recognized. But out of this 240,000, there is a question: how many months services has been provided? So they are asking on 31st December 2007, and the contract machinery was delivered on 1st November 2007. Means only 2 months services has been rendered till now. So out of the 2 year service, only 2 months revenue shall be recognized. So it's like this: machinery revenue should be recognized fully, 510,000. Installation has also taken place. This is 50,000. And out of the service, which is of 240,000, only 2 months out of 24 months has been rendered. Only this much obligation has been performed. This gives you 20,000. So the total revenue that should be recognized is 580,000. So the correct answer is D, 580,000. Okay, next. Craig sales director is close to selling another large machine offering free service, therefore selling the entire machine for 560,000. Craig never sells servicing separately. So servicing, installation and price just at 560,000 at a discount. So how should this discount be applied in relation to the sale of machine? So what I said earlier was discount will be applied to all products. On all the three products, the discount will be applied. On machine, installation and service as well. And how it will be allocated? The package price divided by the total of the standalone prices. This will be the way in which the prices will be allocated as done in previous question. Okay. Then question number 28. What adjustment needs to be made to the revenue in respect of commission sales? So what happens that Craig is an agent. Just note over here, in this situation, what happens in this situation, that Craig is an agent. So agent will receive commission only if he sells the goods. He will not record the whole revenue. So by mistake, he recognized the whole revenue. Revenue will be recognized by the original seller for whom Craig is working. Craig is working as an agent for another seller. So that person will be recognizing 6 million revenue. Craig won't recognize 6 million revenue. Craig will only recognize only the 10% of 6 million. So what happens that he has recognized 6 million as revenue. So what should he do? He should reduce the revenue by 5.4 million. Why? Because 6 million multiplied by 10% makes 600,000. This much he can recognize as revenue. The rest he should reduce. So out of 6 million, he should reduce 600,000. So he should record 600,000. So he needs to reduce the revenue by 5.4 million. So let me work out. See, the correct answer is reduce the revenue by 5.4 million. Why 5.4 million? I'm making a small working just for you to remember. Revenue recorded by Craig was 6 million, and revenue to which Craig is entitled. So Craig was entitled to just 10%, means 600,000. So the rest was excess. The excess amount shall be reversed. So revenue should be reduced by 5.4 million. So the correct answer is 5.4 million. This is B. Okay, let's move ahead. The next question. So next is how much should initially be recorded in revenue in respect of sale of vehicles in the statement of profit and loss account. So what happens in case of vehicles? Let's move on to the question. Okay, what do the question says? Craig sold a large number of vehicles to a new customer for 10 million on 1 July 2007. The important thing is the customer paid 990,000 upfront. So he paid cash 9 and agreed to pay the remaining balance on 1st July 2008, means after 1 year's time. This is after 1 year. So again, there is a financing arrangement and the rate of interest is 6%. So what they're asking that how much should be recognized in Craig's revenue in the statement of profit and loss for the year ended 31st December 2007. So 31st December 2007 revenue they are asking. So you have to calculate the present value in this case. So let's calculate the present value. So the cash paid and plus the present value of the cash to be collected. The sum of both will be the total revenue. So 990,000 has been paid. Rest will be the present value. So please calculate the present value. The remaining amount is 9,010,000. This should be multiplied by 1.06 to the power minus 1 because the amount will be received in 1 year's time. So this makes 8.5 million. The sum of both amounts is 9,490,000. So this is the correct answer. Now he's not asking for the total revenue to be recognized. Be careful. He's just asking about the revenue in respect of sale of vehicles. If he would have been asking for the total revenue in the profit and loss, you would have to record the interest income as well, like in the previous question. So please read the question carefully. So the correct answer is only in respect of the sale, not the interest income. Otherwise, interest is also going to be recognized in the profit and loss account. Okay. So the next question is, the last one of the revenue. Which of the following outlines the correct treatment for the maturing inventory? Now what happened? This is a case of sale and repurchase. So what they say that there is an option. If you remember tomorrow's class, there is an option to repurchase. And if the repurchase option is at a fixed price, then the arrangement is not a sale. In fact, in substance, it's a loan. This is according to IFRS 9. If you remember, sale and repurchase was discussed in IFRS 9. So the correct answer is treat the 3 million as a loan. It's D. D is the correct answer. So it's a loan with a 10% compound interest accruing over the 2 years time since the repurchase will take place. The repurchase will be taken as a repayment of the loan, right? So that's the correct answer. That's end of IFRS 15. Now let's move on to IS 12 first, income taxes. So now that's IS 12 is coming. Now IS 12, you people will be seeing IS 12 on your screen. We'll be starting IS 12. Let me explain a few basics of this IS 12. Before starting IS 12, I'll mute the voice for a minute only, and then we'll start. So you can go through this green block and the yellow blocks. Okay, students, I'm back. Let's start with IS 12, income taxes. Let me brief you a bit about the income tax expense in the profit and loss account first. See, three types of tax expense will be seen in the profit and loss account as expense. What three types? First one is current tax. Second one is deferred tax. And the third is prior tax. The sum of all these items is known as total tax expense. Right? Now, what is current tax? By current tax, we mean that the tax returns you file in the next 12 months. Right? So if you are earning income this year, suppose in 2020, so you will be filing a return in 2021. So that amount which you will be paying in either in the current year or in the upcoming 12 months related to the current year's income, 2020's income. This is your current tax. Now, what is prior tax? Suppose you have filed already a return and recorded a tax expense in 2019, but now you find that the return being filed or the tax payment paid was different to that expense which you recorded at the profit and loss account. So now you need to make an adjustment. to the 2019 tax expense. So obviously this is a change in accounting estimate. So this estimate will be recognized in the year 2020. So one, the tax of 2020. Second, the tax adjustment related to the previous year. And this will arise if you have recorded either lesser expense or more expense in the previous year. So you have to reduce it or increase it in the current year. Change in estimate. And what is the deferred tax? Deferred tax is the tax which is on the current year's income, but will be paid after 12 months time. It will not be paid in the next 12 months, right? So there are three types of taxes that you record in the current year. One, which is payable either in the current year and in the future year and is connected to the current year. 2020's income on which the tax is calculated. So if the tax is calculated in 2020's income, it will come in current tax, and it is payable in the next 12 months or in the current year. And if the tax is on the 2020's income and it is payable after 12 months, then it is a deferred tax. And if the tax is belonging to the previous years and you have to make an adjustment to previous year's tax expenses, then that's known as a prior tax. So the sum of all these is known as the tax expense, which will be recognized in the profit and loss account. Now, rules for deferred tax. What are the rules for deferred tax? So deferred tax rules involve 4 steps. You have to learn these 4 steps first. See, what is the first step? In the first step, you will calculate the difference between the carrying value and the tax base. What is the carrying value? The accounting book value. What is the tax base? Tax base is the book value according to the tax rules. So the values of the asset and the accounting books will be different from the tax books in the tax records, right? So the difference between the carrying value of an asset or a liability in the accounting records and the tax records will be taken first. Then after the difference has been taken, if the carrying value exceeds the tax base, the difference is a TTD. TTD stands for taxable temporary difference. Taxable temporary difference means taxable. You have to pay tax on it, and you are liable to pay tax on it. So what next? You will multiply the difference with the tax rate. Suppose 30% or 31% or 35%, whatever is the tax rate. So multiplying the taxable difference, TTD is the amount on which you have to pay the tax in future after 12 months. So you apply the tax rate on the taxable temporary difference to arrive at the deferred tax liability. This deferred tax liability will be the ending balance. This deferred tax liability will be the ending balance. So what do? We first calculate the deferred tax liability ending balance. So first we calculated the deferred tax liability ending balance in this way. And then we will compare this ending balance with the opening balance. Deferred tax liability's opening balance. So if the deferred tax liability at the end of the year is greater than the liability at the beginning of the year, what does this mean? The liability increase means, why do the liability increase? Due to an expense. So this would result in a deferred tax expense if your liability increase. But if your liability decrease, means your opening liability was greater than the ending liability, you need to decrease the liability. You will be debiting the liability account. So what will be the credit? Profit and loss account will be the credit. So in case there will be a deferred tax credit or a deferred tax income, right? So when the deferred tax liability increase, you will be having a deferred tax expense. But the deferred tax liability reducing, you will be having a deferred tax income or a deferred tax credit. So that's the rule, the 4-step rule, right? Now let's go on to some questions to find out how we will calculate this. So question number 1, Hudson. What do the questions say? The question is asking for the charge for taxation. Charge for taxation means all taxes, current, deferred, prior, all. In the profit and loss, they are not asking for specific current or deferred or prior. They are asking for the total tax in here. So we will be having 3 items in here. The 3 items are One, the current tax, the deferred tax, and the prior tax. See, the current tax amount, according to the question, is 15,000. It's here. For the year ended 30th June 24, the current tax is 15,000. And on the taxation account, you are having 4,000. And this pertains to the year 2003. So if you are having a credit balance in respect of the previous year on the taxation account, means this is an over provision in the past. Means you have recorded more expense in past. So if you have recorded a more expense in past and now you come to know that you are paying less and you recorded more expenses, so your profits reported in the past years were high, profits reported were lower. So what we will do right now in this year, if you have over provided, your last year's profit remained low. So this year you will increase the profits. So this is an income. So that your tax expense will decrease due to this. So this is your prior tax, right? So if I take the tax expense 15,000 as positive, then this 4,000 will be deducted from here, because this is a previous year's adjustment, and in the previous year we had recorded more expense for tax purposes. So this year we will reverse it and we will reduce the expense so that your profit for the current year increase. So the expense decrease and the profits will increase. And what about the deferred tax? What they tell about deferred tax? That the carrying amount of Hudson's non-current assets exceed the tax written down value by 30,000. So what is this? This is a deferred tax liability. This will give rise to a deferred tax liability. This is a taxable temporary difference. Carrying value exceeds by how much? 30,000. So carrying value is higher. So taxable temporary difference is 30,000. Now, if the taxable temporary difference is 30,000, you will multiply the taxable temporary difference 30,000 by the tax rate. So multiply it with the tax rate, which is 30%, in order to arrive at the deferred tax liability ending balance. Right? So the deferred tax liability ending balance is 9,000. Now, what do the question tell about the opening balance? Deferred tax liability opening balance was 12,000. So the liability is declining. So as the liability is declining, DTL is deferred tax liability, right? This is by 3,000. This is a deferred tax credit. Deferred tax income, because if the liability decrease, the liability account will be debited, and what will be the effect on profit and loss account? It will be credited. So there is a decrease in liability resulting in a deferred tax credit. So we are having a deferred tax credit is an income by 3,000. So what's the total of all? This is the tax expense, which is 8,000. So the correct answer is C. $8,000 is the correct answer, C. Okay, students, let's move on to the next one. Remember, this template is very important. This four-step rule. Please learn this four-step rule. The current question started with the second block, the second golden block. It already told you that the carrying value exceeded by 30,000. So in the first step, what I did, this was given in the question. Then in the next step, I multiplied the TTD with the 30% tax rate. When I multiplied it, I got the deferred tax liability, which was 9,000. Then what I do, then I compared it with the opening balance. So what I found that the opening balance was 12,000 and the ending balance is 9,000. So the deferred tax liability is declining by how much? 3,000. So it resulted in a deferred tax credit of 3,000. If the deferred tax liability increased, there will be a deferred tax expense by the amount that has been increased. So this is the summary, the deferred tax working. Okay, let's move ahead. Next question. Achha, I'll be doing question 2 afterwards. First, I'll be doing question number 3. First, we'll do question 3, 4, 5, and then we'll come back to question number 2. Okay, let's do the question number 3 first. Again, the income tax expense. So the income tax expense means the total expense that will be shown in the profit and loss account. So they say that the tax payable for the year, for the current year is 60,000. What is this? This is the current tax, right? Now over provision in relation to the previous year, 4,500. This is the prior tax. Again, over provision. More tax recorded in previous year, more expense in the previous year. So in this year, what you are going to do, you are going to record an income this year because you have recorded more expense last year. Okay, and then look at this. What's happening? The opening provision for deferred tax was 2,600 and the closing is 3,200. So the deferred tax liability is increasing. So this should be an expense by 600. So this results in a deferred tax expense as the liability is increasing. So current tax, prior tax, and deferred tax. Current tax 60,000, prior tax minus 4,500, and deferred tax plus 600 as the liability is increasing. This gives you 56,100. The correct answer is D. Okay, let's move on to the question number 4. Okay, you have to be very careful in question 4. The wordings are very confusing. So please first go through the question. I'll give you 2 minutes to read the question out and then I'll be discussing it. And I would like I would like you people to calculate an answer to this question before I do it to check the accuracy levels. Okay, uh, let me do it now. So what happens in this question that see what figures will be shown in the statement of profit or loss for the year ended 30th September 2001. So we are calculating the expense for the year ended 30th September 2001. So estimated income tax for the year is 83,000, right? This is the current tax. This is for the year 2001. Now what happened in year 2000? Let's look at that. What happened in 2000? That estimated tax was for the year 2000 was 75,000, and the income tax paid was 80,000. What do this mean? That the tax they recorded was 75,000, but afterwards when they paid the tax it was 80,000, means they provided a less amount, they recorded a lesser expense, so they have to further record a 5,000 expense in the current year. So the tax expense to be recorded is 88,000 in the current year. So first of all, there is a current tax. The current tax amount is 83,000, and the prior tax, which was under provided by how much? They had recorded 75,000, but when they made the payment it was 80,000, means the estimate changed and it increased. So previous year they have deducted 75,000 estimated, and current year, in the current year they have to increase the expense for the prior year and reduce the profit. So the total expense makes up to 88,000 is the tax expense in profit and loss. So correct answer in profit and loss is $88,000, and the correct answer in statement of financial position is a liability, liability of how much? The current year's tax. So the current year's tax is 83,000, which is payable, which has not yet been paid because it will be paid in, it is estimated, so it will be paid in the next year. So 83,000 is the payable amount. These are the answers which will be reported. So 88,000 goes there, and 83,000 will be reported in here, in the statement of financial position. Okay, let's move on to the next one. Question number 5. So let me highlight the important figures in question number 5 first, and then we will calculate. At 30th June 2004, the directors estimate the provision necessary for taxation on the current year is 12,000. So this amount in the block 12,000 is the current tax, and this taxation 7,000. This is again a credit balance, means last year they have recorded more expense. So there is a credit balance appearing in the taxation accounts still in the current year. And then the deferred taxation credit is 16,000. So these are the deferred taxation balance 16,000 is already present. So this is the opening balance, and now they say the balance on the deferred tax account needs to be increased to 23,000. This means you have to increase the deferred tax liability by 7,000. Now there is something very important over here, and that is a revaluation gain of 10,000. So where do the revaluation gain goes? Revaluation of property. Where do we record the revaluation gain? We record it in the other comprehensive income. So in the SOCI we have two portions. We have two portions. One is the profit and loss account, and the other one is other comprehensive income. So tax is recorded, some tax is recorded in here in the profit and loss, but some tax is also recorded in OCI, like the tax on revaluation gain. So as the income goes in other comprehensive income, the tax is also recorded in the OCI. So tax on revaluation gain will also be recorded in other comprehensive income. This is very important. So all tax will not be recorded in profit and loss account. Some tax may go to the other comprehensive income. Now what portion will go to the other comprehensive income? The portion of the tax that belongs to the revaluation gain. As the income is going to OCI, the tax will also go to the OCI. So let's make a working to show this. So what happens? Current tax. Current tax is 12,000. Prior tax this is in minus 7,000, and then the deferred tax. The deferred tax expense in total. So the deferred tax expense in total is as they said, they need to increase the deferred tax liability from 16,000 to 23,000. So this makes a deferred tax expense of 7,000. Now out of this, the tax expense to be recorded in OCI is the revaluation gain of 10,000 into 30%. Now remember, the tax on revaluation gain will be a deferred tax. Why? Because the financial reporting standards allow you to record a revaluation gain, but tax department will not allow you to record this gain. So the carrying value will be higher due to the recognition of the revaluation gain, and the tax people will not record this gain. So the tax record will show lower tax base. So always that carrying value will be higher, resulting in a deferred tax liability and a deferred tax expense. So 3,000 is going to profit and loss account. So what amount will appear in the 3,000 will be going to the other comprehensive income. So what amount will appear in the profit and loss account? This is 4,000. So they are asking about the tax that will be recognized in the profit and loss account. So remove the portion going to the OCI. So the total tax in the profit and loss account is 9,000. The correct answer is A. So for you to remember, SOCI includes two types of profits. Two types of accounts. One is the profit and loss account, and the other one is other comprehensive income. Right? Now, some tax will be recorded in OCI. Tax on devaluation gains. OCI, and the rest of tax will be shown in the profit and loss account. So in profit and loss, the tax that appears is tax on income that is reported in profit and loss. So it's simple. There are a few areas only where the income is recorded in OCI. So all taxes related to those income will go to OCI. The remaining will be shown in the profit and loss accounts. Right? Okay, so that's the question number 5. Now question 2 is left. So question 2. Now see what it says. A bit tricky one. Now what happens in this case? You can see, just watch these two amounts first. Watch these two, 25 and 30. Which one is higher? This is higher. Now in this case, see, tax base is higher. In all of the other cases, carrying values were higher. So when tax base is higher, this would result in a in a deductible temporary difference. Right? So the difference between these two, 5 million, is a deductible temporary difference. Deductible temporary difference, DTD. When you apply tax rate on it, you won't get a tax liability. You will get a tax asset. Deductible difference means you will be saving tax on it, on this difference. You won't be paying tax, you will be saving tax on it in the future. So you will get a deferred tax asset. So the deferred tax asset in here is 5 million multiplied by 30%, which is 1.5. Deferred tax asset, this is ending balance. Now, what is at the beginning? That's important. So if you look at the ledger account of the deferred tax liability, in the opening balance, we have a deferred tax liability. The opening balance is a deferred tax liability amounting to 2.4 million. And the ending balance is a deferred tax asset. Again, ending balance is a debit balance. It will appear over here, 1.5. So what's the expense or credit for the year? So you're getting a 3.9 on the credit side, and the debit side is 0. So what will be the balancing entry? You need to have an entry on debit side of 3.9. So deferred tax liability gets debit, and the profit and loss account gets credit in this case. So this is the deferred tax credit. Profit and loss gets credit by 3.9 million. So the entry in here is debit deferred tax liability first. So the deferred tax liability is written off first, which was 2.4 million, and the deferred tax asset is created then. DTA is deferred tax asset by 1.5 million. So both of them are debits. So now what should be the credit? It will be in the profit and loss account. This is the tax expense is getting credited by 3.9 million. So this is the entry. So the correct answer to this is $3.9 million deferred tax credit. Okay, so this is all up for the deferred tax. Now let's start with the borrowing cost portion. Okay, let's move on to the borrowing cost portion. I'm giving you 2 minutes to note down. If you have not noted this, please note down. In the next class, when I will give you the Excel sheet of this IS 12, I will also give you a rule for the deductible difference as well. There is one more block over here related to deferred tax, but mostly they ask the taxable difference. That's why I have not included more questions on the deductible difference. Most questions are on taxable difference. So this is what you need to remember, the four blocks, the four steps of the deferred tax rules, right? Okay, students, you can copy, or if you are noting down, you can note down the answer to question number 2. I'm waiting for 2 minutes. Others can take a small break till 2 minutes until I start borrowing cost. Okay, students, let's start with borrowing cost. So now you can see borrowing cost on your screen. Let's discuss the brief rules of borrowing cost chapter first, and then do some questions. Okay, I'll be discussing this table first. So students, see, accounting treatment of borrowing cost. By borrowing cost, we mean the interest expense, right? So if we borrow money, if we obtain loans, in that case, we have to pay some cost. That cost is known as a borrowing cost, and it's mainly interest expense. Otherwise, the exchange rate changes also on the interest is taken in borrowing cost, right? So there are two rules. If you have taken a loan to construct an asset, not to buy it, to construct an asset or to install an asset, which will take substantial time, means 3 months, 6 months, 1 year, likewise. So if it takes a longer time to construct an asset and you have taken a loan, so interest on that loan can be added to the cost of the capital work in progress or the cost of that asset, right? So the first rule says that recognize borrowing cost as an expense in the profit and loss, and the second rule says capitalize borrowing cost on a qualifying asset. Now, what do we mean by a qualifying asset? The asset which was under construction and it is going to take substantial period of time. So borrowing cost can be capitalized, can be added to the cost of the asset when it is on the qualifying asset. And if it is not, incurred on the qualifying asset, all borrowing costs will be charged to the profit and loss account as an expense. So there is only one instance in which you can add the interest expense to the cost of the asset, and that's the the asset under construction. Now, the next point, how much borrowing cost will be capitalized? So if you have borrowed the amount specifically means that you go to bank and say and tell them that we want a loan to construct a factory building, and they give you a loan. So this is a specific loan. But suppose you do have two loans which were obtained in past, and they are not specifically obtained for building a factory, and you start using money out of it. This is a general borrowing, right? So either you will be borrowing specially to construct a building or an item of qualifying asset, or either you will be using funds from existing loans. So if you are using by obtaining a specific loan, all interest expense being paid to the bank will be capitalized, minus when you obtain a loan, it's too much amount, but you use a little bit out of it. As the construction progresses, you will make further payment out of it. So you will be having some amount surplus. So you invest that amount. So when you invest that amount, you receive income from it. So you can deduct the interest received from the surplus from the borrowing cost that you are capitalizing. So the net amount will be lower than the actual interest that you pay to the bank. So the borrowing cost to be capitalized on the specific loan will be the actual borrowing cost paid to the bank minus the income from the surplus. But in the case of general borrowing, what you are going to do, you are going to multiply the average interest rate on all the loans that you have right now. And apply, and that rate is known as the capitalization rate, the weighted average interest rate to the expenditure amount to arrive at the borrowing cost to be capitalized. Now let's see how it is done from the questions down. Okay, let me tell you one more thing, that you will capitalize the borrowing cost from the date when the asset starts getting constructed. You cannot capitalize the borrowing cost before the asset starts getting constructed. If you have borrowed the amount and you have not started the construction of the asset, all of the interest expense will be charged to the profit and loss account as the expense. Once the asset starts getting constructed, only then you can capitalize it. Secondly, if there is an unplanned suspension in between, if the construction stops due to some unplanned reasons, like suppose due to the material shortage, likewise, or some volcano or some floods, like these type of things. So in that case, you cannot capitalize the borrowing cost during those suspended period, which is known as extended period or unplanned period. In those periods, you will charge the borrowing cost to the profit and loss account. You will not capitalize it. Okay. So I've given the rules for that also. If you look over here, commencement of the borrowing cost, from when will you start? Borrowing cost will start from the date of commencement. Then suspension, borrowing cost will not be capitalized when the work is stopped for an unplanned reason. And work cessation, if the work stops and the construction is over, substantially over, then again the borrowing cost gets recorded gets starting to be recorded in the profit and loss account as an expense. So please remember these rules as well. So let's start doing some questions on this topic. Okay. Question number 16. So what does the question 16 say? That during the current year, the entity had in place 1 million of 6% loan finance and 2 million of 9%. So they already had these loans. This 1 million loan and the 6% rate and 2 million loan at 9% rate. And it started constructing a factory at a cost of 6 lakh. The expenditure is 6 lakh. And this was funded out of the existing loan finance. The factory took 8 months to complete. So what will be the borrowing cost to be the capitalized? So first you will calculate the capitalization rate. Now, how will you calculate the capitalization rate? It's simple. See, take the loan balance. Take the loan balance, which was 1 million and 2 million, and multiply it with the interest rate. Interest rate was 6% for the 1 million loan and 9% for the 2 million loan. Calculate the interest. The interest is 1 million multiplied by 6% and 2 million multiplied by 9%. So this totals to, this sums up to, the interest amount is 0.24 million. We are calculating an average rate. Capitalization rate is a weighted average interest rate. So 0.24 divided by 3 million will give you the capitalization rate. So 0.24 is the interest for the full year and 3 million is the balance amount. For doing this, you arrive at the capitalization rate, multiply it by 100. It's 8%. Okay, so this is the capitalization rate, and the borrowing cost to be capitalized is for only 8 months. So the expenditure amount is 600,000 multiplied by 8%, the average rate multiplied by 8 divided by 12. So this gives you 600,000 multiplied by 8% into 8 divided by 12, 32,000. So the correct answer is 32,000. Okay, let's move on to that's for the working for the capitalization rate and the borrowing cost to be capitalized. Now there is an example of a specific loan. Gilbert took out a 7.5 million 10% loan on January 1, 2016 to build a new warehouse during the year. So they are specially planning to obtain a 7.5 million loan at 10% to build the warehouse. So now the warehouse gets completed on 30th November 2006. So the borrowing cost to be capitalized will start from 1st February 2006, and until only November it will be capitalized, not thereafter. Neither they will capitalize the borrowing cost before February, nor they will capitalize after November. So they have to just capitalize the borrowing cost over the 10 months period. So the interest to be capitalized is 7.5 million multiplied by the 10%. This gives you 750,000, but the interest charge will be for only 10 months. The construction continued for 10 months only during the period. This makes 6,25,000. And secondly, this is a specific loan. What it said that Gilbert invested 2 million in 4.5% bond from 1st January to 1st May. Now remember, in January we are not capitalizing the borrowing cost. So the borrowing cost in the month of January is going to profit and loss account. So the income from surplus will also be recognized in the profit and loss, not in the assets cost. So they have invested the surplus for 4 months, January, February, March and April, but they will capitalize the interest income and deduct from the assets cost just for February, March and April, right? So 3 months surplus income will be deducted from the borrowing cost to be capitalized. So we'll deduct income from surplus only during the capitalization period, during the construction period. Income from surplus. So surplus is 2 million and the surplus was present for 4 months since January, but due to we are not capitalizing the borrowing cost in January, we will also not deduct the income from the assets cost in the month of January. So we will do it only for February, March and April. So the income generated was 4.5%. and we will take it for 3 months only. So this makes the net amount to be capitalized is 602,500. So that's the correct answer. Okay. So students, let's move ahead to the next question. The scenario. Okay. Question number 18. How should the loan be treated in the financial statements of Apex for the year ended 31st March 2008? See, they obtained the loan, 10 million loan, 6% loan, and they will redeem it at premium. Means the cash flow test and the business model test is present. Both the tests are present. So they are going to hold the loan till the end of the maturity, and they will follow the cash flow. They will pay the same interest which is predetermined and the amount that is predetermined to be repaid by the end of the maturity. So the correct answer is the financial liability should be recognized at amortized cost. So the correct answer is D. Okay. Next is question number 19. So in question number 19, they say which of the two statements below regarding IS 23 borrowing costs are correct. So which two are correct? The first one is correct. Borrowing costs must be capitalized if they are directly attributable to the qualifying asset. Now see, this option A and option D are very close. There is a small difference between option A and D, and the difference is in option A it's a must, and in option D it's a may. This is not correct. IFRS requirement should be followed. It's 100%. It's mandatory. So you can't say may. So this is not correct. Due to this, the option D becomes wrong. Now, so the option A is correct, and then the second point, the borrowing cost should cease to capitalize once the related asset is substantially complete. So this one is also correct. So the correct answer is A and B. C is also not correct because borrowing cost must be capitalized if they are directly attributable to non-current assets. No, not directly attributable to non-current assets, directly attributable to qualifying assets. So if you are buying a non-current asset, you can't capitalize. If you are acquiring or constructing a qualifying asset, you are acquiring an asset which takes substantial time to acquire, only then you can capitalize it. So all non-current assets, borrowing costs against all non-current assets cannot be capitalized. So the correct answer is A and B. So it was some wording test from you. Okay. So let's move on to the question number 20. How much should be recorded as finance cost in the statement of profit and loss for the year? And question 21 is, how much interest should be capitalized at cost of property, plant, and equipment as at 31st March 2008? So in question number 20, they are asking that how much of the interest should be recognized in profit and loss, and 21 they're asking how much should be capitalized. So both are connected to this question. So what do they say? That they obtained a loan of 10 million and interest is recorded at the effective rate, always 7.5%, right? So interest expense will be 7.5%. Now what happens? The construction of the store commenced on 1st May. So the borrowing occurred on 1st April. So borrowing cost will not be capitalized in the month of April because the construction starts on 1st of May and it was completed and ready for use on 28th of February. Again, after February, borrowing cost will not be capitalized. That is in the month of March. So there are 2 months, the month of April and the month of March 2008, in which the borrowing cost will not be capitalized as the construction work began on 1st May and ended on 20th of February. So the construction continued for how many months? It continued for 10 months. So during 2 months, the construction was not taking place. Therefore, those 2 months borrowing cost will be recognized in the profit and loss account as an expense. So the answer is as follows. $10,000 was the loan multiplied by 7.5% the effective rate multiplied by 2 divided by 12. This goes to the expense in the profit and loss account. $1,25,000 and 10 million multiplied by 7.5% multiplied by 10 divided by 12. $625,000 goes to the cost of the asset. So that's the correct answers. This is in thousands. It's 125,000, but I've taken in thousands. Okay, let's move on to the next one, and that's question number 22. So what do they say? Apex decided that not all of the funds raised were needed immediately and temporarily invested some of the funds in April. Now, please concentrate on the wordings. They are talking about April 2007, in which they earned 40,000, right? And in the question, they have said that in April they did borrow the money, but the construction did not begin. So where was the borrowing cost going to? Borrowing cost was going to the profit and loss account as an expense. So income will also go to the profit and loss account. So expense, income, both going to the profit and loss account. So what's the correct answer? It's B. The income will be recognized in the profit and loss account as the construction has not yet started. Correct answer is B. As the construction has not yet started, in April 2007, neither the interest expense nor the interest income will be recognized in the CWIP. CWIP is the capital work in progress. Asset under construction are known as CWIP. Right? Okay, students, this question number 23 till the end is your assignment. It's only question 23 is left. And then building will start. So question 23 is your assignment. Please do it. I will give you the answer to the question 23. It's B. Option B is the correct answer. B is the correct answer too. You have to try this out. So this is your assignment for tomorrow. Now we move on to the next standard, IS 36. Okay. So students, let's start with impairment of assets. Let's do a few questions on impairment of assets. I'm muting the voice for a minute and then I will start again. Please allow me a 1-minute mute. Students, I received a question a few minutes ago that let me answer that question first before I move further. That how did I know that revaluation gain was going to OCI, right? So remember, when you revalue a property, let me move back to IS 12. Moving back to IS 12, see, what did it say? That during the year, Homs revalued its property for the first time, resulting in a gain of 10,000. Right? So where do the properties gain go to? The revaluation gain is recognized in OCI, other comprehensive income. From there, I came to know that it goes on to the OCI. So if the income is going to OCI, the revaluation gain, then the tax will also go to the OCI. Okay. So there was one more question about explaining question 17 again. So let me explain question 17 again. This Gilbert one. Now in question 17, what do it say? That see, they obtained a loan of 7.5 million, right? And the interest on it was 10%, right? Now this 10% means for 12 months, right? The construction began on 1st of January 2006. So they did obtain the loan on 1st January, but the construction did not start. So in the month of January, as the construction did not start, we cannot capitalize the borrowing cost. We cannot add the borrowing cost to the asset, right? And again, the construction was completed on 30th of November. So as the construction was completed on 30th November, in the month of December, the interest expense will be recognized in profit and loss account. It cannot be capitalized because the building has been, the warehouse has been constructed. So once the building has been constructed, then you cannot capitalize it. Agreed? So what happened that two months, in the 2 months, January and December, the construction was not continuing. So I couldn't capitalize the borrowing cost. So in those 2 months, the borrowing cost is going to the profit and loss account, right? And then the 2 million surplus will also be considered from the month of February, not in January, because January cost is also going to the profit and loss account. So income will also go to the profit and loss account, right? Okay. So these were the two questions, and but there is one more question, sir. In remote invigilated exam, will the examiner check our workings? So see, if you are doing a constructed response question, your workings will be checked. But if you are doing an objective type question, your working will not be checked. In objective type questions, your workings are not being checked, right? So you just do the workings for your own sake only, not for the examiner viewing purposes, right? But in constructed response questions, workings are important. If you don't make workings, you won't get full marks, right? Okay, let me take some more questions. So I have answered Mufaddal's question. Okay, so question number 22 in IS 12. Okay, question number 22 in IS 12. Let me answer that also, then we'll go to the impairment of assets portion. Okay, question number 22. See, what do the question number 22 says? Okay, IS 12. Sorry, but we are not having any question 22 in IS 12. Question number 22 is in IS 23, right? So what you want to ask, question number 23 in IS 23 or IS 12? Or you want to ask question number 2 in IS 12? I think it won't be question 22. It's question number 2. I believe. Okay. So let me discuss question number 2 in IS 12. See, this was a tricky one. First point. In this case, see, look my marking in doing first. The carrying value of the net assets is 25 million, right? And now in reading, the tax base is 30 million. So tax base is higher, as I said. When the tax base is higher, if tax base is higher, the difference will be a deductible difference. The difference between 25 and 30 is 5 million. This is the deductible temporary difference, right? This is not a taxable difference. You're not going to pay tax on it. You're going to save tax on this 5 million. How much tax will you save? It is 30%. So 30% of this is 1.5 million. So this is a deferred tax asset. 1.5 million is a deferred tax asset at the end of the year. So where will you report it? This is a debit balance, appear over here, right? And 2.5 million was the credit balance at the opening. It is reported here, right? So if I put the opening and ending balance over here, where do I need to adjust? You should have a 3.9 million entry over here in the deferred tax liability. 3.9 millions you can see over here. Look, a debit of 2.4 to finish the liability and a debit of 1.5 to bring in the asset. So total 3.9. And where goes the credit to the profit and loss account? So this is the credit to the profit and loss account, not an expense. Expense will be debited. So this is the deferred tax credit, right? Okay. This was, I think, some Muhammad, Mr. Muhammad. Okay. So I hope the questions of people have been answered. Sakhawat asks that, sir, tomorrow we'll do group accounts. Yes, tomorrow and day after tomorrow we'll be doing 3 things: interpretation, financial statements, and consolidation. So it depends that what topic I pick tomorrow and after tomorrow. The sequence is not, I cannot tell you exactly because I have some more topics also to do. So it's probable that we may be doing consolidation tomorrow, right? Okay. So let's move on to the impairment of assets. We'll be able to do at least one question on impairment, then we'll do tomorrow. So moving on to IS 36. Okay, impairment of assets. The first question, question 24. Now remember one thing regarding the impairment of assets, that an asset's book value in the financial statement should not be greater than its recoverable amount. What is the recoverable amount of an asset? You can recover the asset's cost by either selling the asset immediately, which is its fair value, or you can use the asset and generate revenues in future. The present value of those revenues is known as value in use. So either you will generate revenues from using the asset or by selling the asset now. So the higher of these two, benefit from using it and benefit from selling it, is known as the recoverable amount, the higher of these two. So the asset should not be carried at more than this amount, because if you carry at an amount more than these, you are overstating the asset. You're not going to get the benefit, but you are showing it in the financial at a more amount. So that's wrong. That's unfair. So that will be misleading. So the difference between the assets carrying value existing and the recoverable amount, if carrying value is more, is known as impairment loss, right? So impairment loss is the difference between the carrying value and the recoverable amount when carrying value is higher. The difference is impairment. So what do they say over here in this question? That following a period of losses, the recoverable amount of division is deemed to be 4 million. Now, there is an impairment loss over here because if you sum up all these items, the sum of all these items is more than 4 million. It is 5180 approximately. You can sum it up, it is around 5180. So this is greater than this amount. It's recoverable amount. So there is an impairment loss. And impairment loss will have to be allocated amongst these items, right? Now, the question is very simple. They are asking about the building. See, what is the book value of the building? It's 2.3 million. And what is the market value of the building? 2.5 million. So market value is 2.5 million, means no impairment. Because if you sell it now, you will be able to receive 1.5 million. And the asset being shown in here is 2.3 million building, right? So you are not overstating it. You are not overstating the asset. The asset is being carried at 2.3 million and you are expecting to receive 2.5 million. So there is no impairment loss over here. So the amount, no need to record any impairment on building. The building will remain at 2.3 million. Secondly, the company is using cost model. It's not using revaluation model that you will revalue it. So this is not the correct 2.5 million answer because they are not using the revaluation model, right? So impairment loss will be recognized only when you are overstating an asset. The asset is not being overstated over here. The carrying value is lower than recoverable amount. It's not more. So the correct answer is A. The correct answer to this is A. Right. So I think it's very close to the end of the time for today. So I would wish you all the best. So please make a lot of efforts so that you do a lot of practice, and your practice will increase your success rate. So I wish you all the best, and we will see. I'll see. Inshallah, will be a meeting tomorrow. So until then, goodbye. Take care. Aruj, let me answer you. We are subtracting. We are not. We are subtracting the income from surplus because we are borrowing specifically. So for if you are borrowing specifically for construction purpose, then you can deduct the income from your surplus from your borrowing cost to be capitalized. Okay. I hope we have got the answer. But in general borrowing, you cannot deduct the income from surplus from the borrowing cost.